coming on the back of an extended period of flatline performance from the Indian markets. Two, that the world markets, as you said, face this downside risk. So how does therefore India and EMs do in that aspect? And three, also couple this interest rate argument with what India could do as well, because the RBI has left the door open for a hike as opposed to the market perception before the policy. Now, and therefore, if indeed the West stays higher for longer, and the impact that it may have on the RBI decision as well. So combine all of these three and tell us what is your view on India?
I think that India market need to have another year of consolidation. And there are 2 or 3 points, Neeraj. One is that despite the flat to negative returns we got last year, valuations in multiples are not just above average, but they're higher than where they were in December 19. Right? So just pre-COVID quarter, we are still higher than that. So if the whole world is reopened, activity is back to pre-COVID, why are valuations still higher than pre-COVID? Right? That becomes an argument very difficult to justify, especially in the light of the fact that liquidity is tighter than pre-COVID, rates are higher than pre-COVID. Why should Indian multiples be higher than pre-COVID as well? So there is no justification that I can find mathematically to support that view. Secondly, the earnings outcomes are also deteriorating. So in the last 2 quarters of Indian reporting, you've seen very significant cuts to Indian numbers, especially for the domestic facing businesses. And this combination of high valuation earnings downgrades means that you need to have this period where you get some growth in earnings so that the headline valuations get back to slightly more reasonable levels. What is the impact of inflation on RBI? I think if I start with the other way around, Neeraj, I'd say, look, the RBI is unlikely to cut rates until the Fed does. It will be very difficult for the RBI to anticipate Fed action, to cut ahead of the Fed, because the rate differential between India and the US is still very narrow, right? And this is, let's say, not the policy rates, but the market rates and corporate bond rates of onshore versus offshore still very narrow. This is, to my mind, driving capital out of India. So there is very little room for the RBI to go out and say, hey, I'm cutting rate because my inflation has fallen or my growth is slower, because we have other variables to factor into the thought process as well. How does this affect equities, Neeraj? And this is a note we did about 15 days ago. RBI liquidity, okay, anticipates mid-cap performance. It's a very great correlation. And when the RBI injects liquidity in the system, with a lag, we start to see mid-caps doing well. And when the RBI pulls it back, mid-caps start to underperform. Now, what's happened in the last 6 months, the RBI, while raising rates, has actually withdrawn this liquidity tide completely almost. And therefore, we actually titled the note, Sell All Indian Mid-Caps. Because by quantitative correlation, the lack of a receding liquidity in the market is bad for the beta mid-cap sectors in India. So maybe the RBI tightness doesn't really affect the headline Nifty, but it can affect the broader market in India.
And I guess that would still be your stance, that stay light or get out of mid caps largely, stick only to large caps.
Right. And we've seen this, unfortunately, in many cycles previously, Neeraj, where people forget about liquidity risks. This is true in India, it's true everywhere in the world. In the bull market, you're all gung-ho, but that liquidity filter is important in periods of weakness. And in India, you don't want to be stuck in a stock you can't sell.